Good evening. Welcome to our Kansas University Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. We're waiting for everybody to join tonight's class, so we're going to give it a few more minutes before we kind of take off with our content and get a chance to share this with you. Our workshop runs just about an hour, so we should be able to take us to the top of the hour. This is a very interactive session, so we'd encourage ask questions as we roll through tonight's content. We're going to be kind of talking about all the basics of home ownership and help kind of giving you the tools and resources to help you on that path towards home ownership. So we're really excited to be with you this evening. We'll get started in just about 2 minutes. So I'm going to go off camera for just a bit, and then we'll go ahead and launch into tonight's class. Thanks again for joining us. All right, well, let's go ahead and get started. Again, thanks so much for taking time out of your busy schedules to get a chance to hang out with us. Again, my name is Jason Maida, and I'm with an organization called American Pacific Mortgage. And we've been very fortunate to get a chance to partner with the Kansas University alumni. And we're bringing workshops 4 times a year to the community. This is our second installment of workshops. We have 2 more for the balance of 2024, and then next year we'll do it all over again. We're a nationwide lender that focuses on home buying. We also do refinancing as well. Of course, in today's market, refinancing hasn't been as popular, but as rates start to settle a little bit, we'll probably see more refinance activity begin to pick up. As I mentioned, we're a nationwide lender, so as we're supporting clients all across the country in home ownership, we generally start with educational classes like this, and we're really focused in on first-time homebuyer resources. So that's what you're going to learn a little bit about in tonight's class. And here's what some tonight's talking points look like. We're going to spend some time looking at the housing market in just a bit. We'll probably spotlight a little bit of the Kansas market, but we'll also kind of talk a little bit at what it looks like, across the country. We'll spend some time looking at interest rates. In fact, today was a busy day from an economic perspective that I'll kind of share with you some insight. We'll talk a little bit about a home buying budget and what that looks like for you, comparing your current housing situation versus what it could look like renting. Also talk about credit, documentation and loan financing, student loans, how that can impact your financing options, loan programs that are available to you, as well as assistance programs. And we'll also talk a little bit about the buying process. So after tonight's class, if I'm kind of thinking about, I'd like to put together a home buying plan, set some goals for myself, maybe some objectives towards home ownership, we're going to show you how to get on that path towards home ownership. All right, so when we think about home ownership, there's a lot of great benefits that come along with it, especially when we compare that versus renting. We can, create a little bit more stability for ourselves with our housing budget. I do understand the cost of housing is a lot more than it has been in past years, but, being able to say, hey, this is what my monthly payment is versus waiting on a landlord to possibly increase your rent amount, that gives you a little bit more control from your financial perspective. Homes will hopefully increase in time in value. The difference of the market value of the home versus what you owe on your house, that difference is called home equity. This is an asset that will hopefully achieve higher values over time. It's a way to create generational wealth for you and your family. And there still can be some really great tax benefits, believe it or not, that come along with home ownership, potentially tax deductibility of interest in owning a home. So a lot of great things we want to kind of think about and really kind of think through when it comes to home ownership. And I think a great launching point for us in tonight's class is to first kind of spend some time looking at renting and what that could be like for us over a long period of time versus what it could look like from a buying perspective. We do understand that the cost of housing in general is at all-time highs right now. That's one of the biggest components of expenses for many of us across the country. And I think, looking at getting into home ownership, we got to figure out all the great value adds that come along with home ownership and then how that kind of stacks up from a budget perspective. So I want to take some time looking at a rent versus buying calculator. And this is going to kind of give us like more of a side-by-side comparison. As a quick side note for our class, all of our information that I share with you this evening, we're going to send back out to you via email. So since you've signed up for tonight's class, you're going to get a link to the video of tonight's class. So we're going to record tonight's Zoom session and also all of the presentation material. And if you'd like to share that with friends, family, coworkers, we love to have them kind of check out some of that material. And I'll let you know about some other future classes we'll have coming up here soon too. So let's talk a little bit about our rent versus buying calculator. And we've kind of pre-filled some items in here just for timing purposes of tonight's class. But if we were to say, we took a scenario, and you can see on screen here that let's say we had a monthly rent estimated at $17.50 a month. We had monthly renter's insurance calculated around $15 a month. And then we're going to project out in this calculation that our rent rate would probably go up about 5% on an annualized basis. So as I renew my lease, maybe my rent's going to go up by about 5%. So that's on the rental side of the equation, right? And then we look at from a home purchase perspective, if we bought a $300,000 house, let's say the minimum down payment, which we're going to learn a little bit more about in just a bit, is 3%. We factor in property taxes for that house as part of our budget. We factor in homeowners insurance. And then we want to kind of take a look at, what are some of the costs that I might have to have in my budget to maintain this house? So maintenance costs, of course, if I decide to purchase maybe maybe an older home, it might require a little bit more on the budget side from a maintenance perspective. But, when we think about home ownership, we're going to have to rely on ourselves to, fix items, so to speak. And then on the loan side of things, we're going to take a look at, what type of loan we're going to have. So let's say it's a 30-year fixed mortgage. We're going to plug in an interest rate of, somewhere between 6.25 to 6.5%, depending on where the market's at. We have origination costs. So that's what lenders will charge you to acquire your financing, right? Those are also under the umbrella of closing costs. We generally recommend buyers to budget about 2 to 3% of their overall sales price for closing costs. Now, one of the great things in our partnership beyond just our classes that we provide to the KU alum is we actually discount our services for you as well. So as you decide to work with our team in home financing, we discount our cost by $750. I'll share more with you about that a little bit later in tonight's class. And then when you select financing options, there's a thing called discount points that you can elect to take as a consumer. And what discount points are is when you decide to pay additional monies out of pocket that will help bring down your interest rate. So for example, if rates today are 6.5% and you decide to pay 1 point, which is the equivalent of 1% of your loan amount, that amount out of pocket would generally reduce my rate by, let's say, about 0.25%. Now, in today's market where interest rates are starting to kind of, maybe redirect a little bit, start to decline somewhat, most of our clients that are buying in today's market are probably not going to keep that loan for a long period of time, probably the next couple of years. So generally, when we invest in discount points, it's going to be a break-even point of about 3 to 4 years. So I really don't recommend investing in discount points right now because you can't get a really good return unless we have to invest monies for like that from a qualifying perspective, or maybe we're just trying to get to a certain payment level. And then we have other settlement services. Those are going to be like title and escrow fees, attorney's fees, depending on what state you're joining this from or you're going to purchase in. Generally, like I said earlier, closing costs to purchase your home will generally be about 2 to 3% of your sales price. And then, of course, we want to have savings set aside for the down payment of our home. So that would vary based upon what we decide to contribute from a down payment perspective. And then we have other assumptions that we're going to make in this equation. We're going to look at, what's the appreciation rate going to be of my home? We projected at 4%. How long do I think I'm going to stay in this house? How much is it going to cost me to sell my home? What are the state and federal tax rates that I'm going to purchase in? And then finally, if I compare home ownership and then plug in today's savings rate, what would that look like for me? And so we added 3% for today's class, but I know for savings accounts, we might see 3-4% yields in some of those high yield money market accounts. So when we look at our calculation, we want to first kind of take a look at the payment difference, right? So if you were to consider staying on the path of renting, you're still going to be in that $1,700 to $1,800 range. If you decide to purchase, that's going to leap our monthly payment up, right? So now we're going to be getting closer, what we're in the high 2000 range. So we're clearly going to have a step up in our monthly payment. But at the same time, we got to consider those benefits that come along with ownership. So when I compare that from a cost perspective over time, it actually has about a $54,000 opportunity of owning my home versus renting. Now, you might ask yourself, like, how did you get to that number? Well, how we got there was taking in consideration the appreciation of my home over the next 7 years. If it appreciates on average about 4%. We also factor in the tax benefits of interest that you could potentially have in owning a home. So those are factors that we can realize in home ownership that we might not see from a rental perspective. Okay. Now, I would encourage you after tonight's class, you're going to have the presentation material tomorrow morning. Take some time, do your own calculation. I think it'd be super helpful for you to kind of understand that comparison of your current housing situation versus what it could look like from an ownership perspective. All right, so let's talk now a little bit about the housing market. And I didn't get a chance to kind of poll the audience to see where you're at, but in terms of where you're at located in the country. But if we were kind of just generally in the Midwest or West Coast or East Coast or in some of the southern markets, the housing market looks fairly similar. Now, it may not look the same from a sales price perspective. In fact, we're looking at Kansas's median sales price on screen now. But I think the activity levels in the market look very similar. When we look at our housing market in the Kansas market per se, average sales price 289. We're seeing, the median sales price uptick a little bit year over year. You can see kind of the trend of buying right now over this last 3 years, but I think more importantly, kind of right here. If we were to kind of push this out a little bit, we're seeing a little bit of decline here. Some of it could be because of seasonality in the markets, because we had a little bit of a slow start in our spring and summer buying. We generally see a pretty nice lift in activity levels in April and May, and then it kind of continues into the spring and summer months. But this market has been a little bit different here. I think the average consumer is trying to figure out, like, where are interest rates going and when am I willing to jump into home ownership? Or maybe I got pre-approved 2 years ago and market rates were 3% and now they're 6%. Like, can I afford to get into this market? So I think we've seen a little bit of a delayed reaction from the consumer. And so now if you look at where we're at today in the market, we're in August, but July, we really started to see an uptick in buyer activity all across the country. I think the average consumer has kind of come to the conclusion that interest rates aren't going to move a lot. And so, if they're going to get into today's market, then, they're probably gonna have to do it now, because generally as interest rates decline, buyer activity picks up. And we do have a little bit of a challenge in today's market. There's just not a lot of inventory to support increased buyer activity. Whether that's because we don't have builders that are building enough homes to support the new buyer activity, or it's just not a lot of sellers willing to sell their homes, right? So I think you're seeing a lot of buyers now saying this is the new world we're in right now. It's probably a 6% level. And, now we're going to get into the market. So we've definitely seen the activity levels kick up quite a bit. Now, this chart shows you interest rates over the last 12 months. And, we're having a nice little trend here over the last 60 days. In fact, just 2 weeks ago, we hit interest rate levels that were equivalent to what we saw in April of 23. Now, today was a big day from an interest rate perspective because two things happened today in the economic markets. One is we did get some job numbers that came up, employment numbers that came out about a month ago. It showed an increase of about 180,000 jobs. However, just today, that report was retracted to eliminate those $180,000 jobs. 180,000 in jobs. So it actually turned that report around. So, one of the big things that the Federal Reserve is looking at in terms of rate activity is, or what they're going to do with rate activity in the future is, how is new job creation looking like? What does our employment situation look like? The other thing is on the inflation side, and inflation has started to come down slightly. And so we're really watching what the Federal Reserve is going to do. And so today, the Federal Reserve released their meeting minutes from their most recent meeting, which gave some indication that there probably will be a Federal Reserve rate cut in September. Now, we don't know what that's going to look like. It could be 0.5%, could be 0.25%, but we just don't know. So we're going to be kind of watching really intently on that. I think it's important to know as a consumer that when you start hearing the news outlets talk about the Federal Reserve cutting interest rates, that doesn't necessarily mean For example, if they cut a 0.5%, doesn't mean it's going to be a 1-to-1 ratio with mortgage interest rates. So if the Federal Reserve says, hey, you know what, we're going to cut rates a 0.5%, doesn't mean mortgage rates fall to 6%. It's a gradual progression of interest rates falling in the mortgage space. In fact, we might even see some rates start to decline leading into next month's meeting with the Federal Reserve. So we're going to be watching that obviously really intently. Interest rate environment obviously drives buyer activity, not just from a home purchase perspective, but also from a refinance perspective. And that's where existing homeowners get a chance to refinance their loans at lower interest rates to help create savings for their families. Right now, all interest rates aren't the same for all buyers, and there's a few characteristics that go into your interest rate offering. Could be credit eligibility, it could be the product that you're selecting, how much you decide to finance. Do I put a down payment of 3%, which is the minimum, or do I put 20%? Now that could change my level of interest rate. We talked earlier about discount points, that's where I pay additional funds out of pocket to lower my interest rate. And then the term of my loan can also drive my interest rate. So if I select a shorter term of loan, that could possibly give me a lower interest rate option. As we meet with clients to design their home buying plans, we're going to figure out what options work the best for you, give you an indication of what market rates look like. And so you can have a good idea of what your monthly budget's going to look like. Now, as interest rates go up and down, that budget might change a little bit, but I think we have good things on the horizon from an interest rate perspective. I think we'll probably see some declines coming into the latter part of this year, and then hopefully see more improvement in 2025, and hopefully get to more of a normalized kind of historical level in 2026. So kind of, what we're projecting out. Now, when we think about interest rates in our product selection, credit's going to play a big role in that for our buyers. Now, there's usually two challenges for most buyers when it comes to designing their home buying plan. It could be just lack of savings because I haven't got a chance to save up for my down payment and my closing costs, but it can also be around credit. So in our classes that we teach, we always like to kind of share with you just some tools and resources, maybe some tips to help you improve or kind of continue to do what you're doing from a credit perspective. So I think it's really helpful to first understand what goes into FICO score calculation. We all know there's 3 different agencies for credit reporting. There's Equifax, Experian, TransUnion. There's also a weighting to the credit score model. Now, there is 3 different models to scoring, such as the mortgage model, which we're going to look at when it comes to housing, right? There's the credit card model, and then there's the auto finance model. So this is kind of what the mortgage model looks like. 15% is going to be, how much credit have I had, or for how long have I had my credit, right? So the more mature my credit file is, the higher my credit score could potentially be. How much new credit am I trying to obtain? Am I opening up a bunch of new accounts? Do I have new inquiries on my credit? Those will impact the 20% weighting of your credit score. Now, one of the things just to keep in mind in working with our team, when you decide to take those next steps in homeownership and consult with us, there is not a hard inquiry that we do. We only start with a soft credit check to begin. And the reason why we do that is because we don't want to impact your credit score. Because, many of our first-time buyers are not ready to go out and look at homes this weekend, right? It could be a process that's several months down the line. And so we don't want to impact that credit score by doing a hard inquiry. So that's why we always start with a soft inquiry. 30% is going to be around revolving credit. That's also known as credit utilization. And really simple there, we're looking at your credit balances versus what your credit limits are. Ideally, you want to have your balances at 10% of the credit limit or less. If you're kind of struggling paying down some revolving debt and maybe you're at 80% revolving or utilization of credit, we'd encourage you to try to take the first steps and get that below 50%. That'll give you a nice little uptick in your credit score, and then gradually work towards the 10% utilization. Now, when we look at utilization of credit, that's all reported out to the credit bureaus by the credit agencies on a monthly basis. They report that data on the billing cycle date. And one of the tips I always like to share with our class is that if you can change your habits of paying your credit card down or off before the end of your billing or statement date, that's going to give you a much lower balance reported out to the credit agencies and hopefully give you a much higher credit score. Okay. So that would be kind of the workaround versus paying on your due date. Try to pay before the statement or the billing cycle date. Last component to the credit score for mortgage is going to be around payment history. That's the biggest weighting component. It's 35%. And we're looking at how we paid our bills, right? So, especially in the most recent 12 to 24 months. So, if I've had a late payment, those late payments get rated as 30-day lates, then 60-day lates, and then 90+ day delinquency. So, the more severe my delinquency is, bigger impact I'm going to have to my credit score. Now, every loan program has a minimum credit score attached with it. You can see those on screen. We're going to dive into loan programs in just a few minutes, but every program is going to have a minimum score attached with it. As we design home buying plans for you, we're going to figure out which product is the right fit for you. And then when we look at the length of credit component to the credit score, one thing I always like to kind of share with our class is just kind of, or more of kind of a, just be aware is that when you close out a credit card, so a revolving account, when you close out that account, it actually takes away all the history from the credit bureau. So if I had an account that I've established for 10 years, great pay history on it, highest credit limit, and then I close that out, well, all of those great factors to the model gets pulled out of the scoring. So just be careful before you start closing out accounts. And there's 3 different credit scores that get reported from each one of the agencies. So Experian has their own score, TransUnion, Equifax. Now, we always take the middle credit score of all 3 bureaus. So here's what I mean by that. If my highest score is 760, my middle score is 740, my lowest score is 720, we're going to take the 740 score from a qualifying perspective. Now, if I have a partner that wants to join me on the application and their score is 720, 700, and 680, well, their lowest score is 700, the lowest middle score is 700. That's what we would be using from a qualifying perspective. Now, that can impact your interest rate offering, can impact your mortgage insurance, can impact the product that you can select. So those are things that we'll kind of strategize with for you during a consultation and try to figure out ways that we can potentially improve your credit score with simple action steps. Now, if you've had some past challenges from a credit perspective, this is how long those negative items will stay with you on your credit. So this is kind of a matrix to show you what that looks like. As I mentioned earlier, if you've had some challenges in the most recent 12 to 24 months is going to be kind of the biggest impact to your credit score. So the further I get away from a late payment, so let's say, for example, I had a late payment in October of 2023. Well, that's in the most recent 12 months. So as I continue to move further past that late payment, I should see some kind of incremental lift in my credit score. Now, one of the things that shows up on credit reports is student loans, of course. And most of our clients that I work with across the country are going to have some type of student loan, just the reality of higher education right now. But I think at the same time, that's not necessarily something that can prohibit you from purchasing a home because there's different ways that we look at student loans. If you're on an income-based repayment program, we can use that payment to qualify you. If you're in forbearance or deferment, we still have to count a minimum payment. Generally, for a conventional loan, which you're going to learn about in just a minute, is the Fannie Mae and Freddie Mac loan. We take 1% of the outstanding balances. We use that as the payment. Or if you're doing an FHA loan, so it's a federally insured loan, then we take 0.5% of the outstanding balances as the monthly payment. So there's a variety of ways that we can kind of get through student loans, but it's not necessarily a barrier to homeownership. If you're in if you have forgiveness of student loan debt, if we have documentation of that, and maybe it just hasn't reported to the credit bureaus yet, we can always extract that from the qualifying numbers. But these are things that we'll kind of talk about in meeting with clients around student loans and kind of how we can navigate those waters. Now, loan programs obviously are going to be kind of what is going to provide you with the financial resources for home ownership. So as we meet with our clients in classes or in one-on-ones, and then of course in doing workshops like this, I like to give you kind of a look into each one of these products because you've probably heard about them before, but I want to kind of connect the dots for our class. And the first one we'll kind of talk a little bit about is the conventional loan product. So when you think about conventional loans, those are Fannie Mae loans, those are Freddie Mac loans. They do have a minimum down payment of 3% for first-time home buyers, up to a loan amount of $766,550. So that's called the conforming loan limit. It's for most parts of the country, but if you get into some of the higher cost of living areas, some of our East Coast markets, some of our West Coast markets, you're going to see higher loan amounts that we can go up to as high as $1.149 million. Now, that does also elevate the minimum down payment from 3% to 5% if we go beyond the conforming loan limit. Now, conventional loans take up about 70% of all originations across the country. And so that product has minimum credit score requirements that are set from Fannie Mae and Freddie Mac at 620, and there's other also parameters within what we call underwriting guidelines. Now, the next product is the FHA loan. So that's the Federal Housing Administration loan under HUD, which is a Housing and Urban Development. And so it's a government insured loan. So it adds a little bit more flexibility for the buyer. There's a little bit more expense attached to that product, but it does have a minimum credit score of 580, minimum down payment of 3.5%. And then the loan amount that we can lend under FHA will vary based upon where we're at in the country. So if we're in, say, the Kansas City market, it's going to be a maximum loan amount of $498,250. In just a minute, I'm going to do a quick comparison around mortgage insurance between conventional loans and FHA loans. I think you'll find pretty helpful because for most of our first-time buyers, we are going to be paying mortgage insurance because maybe we're just not quite at 20% down. So we'll kind of walk through a brief little side-by-side comparison. Now, for our veterans that have eligibility, there's the VA home loan. That is a federally insured loan for our veterans. It allows more flexibility for our veterans to be able to purchase. Credit score goes down to 620 credit score. Even more flexibility from a loan perspective where there really is no loan limit for the VA home loan. We just have to meet qualifying parameters. Usually maximum loan amounts tap out around $1 million to $1.5 million, but just a great loan to help support our veterans. And then there's the USDA program. So if a client wants to purchase in what we would consider rural areas, the United States Department of Agriculture has kind of rural areas that will be designated as eligible for this financing. The big benefit with USDA is a zero down payment option. And you can see the maximum loan limit, which will kind of follow the conforming loan limit. There are two big qualifiers for USDA. It's the location of property has to be deemed rural. And then there's income qualifiers based upon the household income. And then finally, there's the jumbo loan product. Those are for clients that are looking for a little more financial resources because maybe they're purchasing at a higher price level. It usually requires a down payment of anywhere between 10 to 20% down. A little more assets are required, not just from a down payment perspective, but also from a what we call as reserves standpoint. And what reserves are, those are additional funds that we have available to us after we've contributed our down payment as well as our closing costs. Usually reserves on a jumbo loan can be somewhere around 12 months to 18 months of the total monthly payment. So, if we took an $8,000 mortgage payment, which would be quite a bit for a first-time buyer, that would be an additional $96,000 in assets that person would need to have left behind. So when we think about PMI, and you've probably heard of that terminology. In fact, some of you that have maybe done some quotes on Zillow or Redfin through some of their calculators, you're probably seeing PMI pop up because you didn't put 20% down. PMI stands for private mortgage insurance, which relates to a conventional loan. And then FHA has government insured mortgage insurance. And so I want to kind of walk you through what this looks like in each kind of scenario. And let's start with the conventional loan. The conventional loan, Fannie Mae, Freddie Mac loan products, has various ways that you can pay mortgage insurance, but it's going to come into play when we put less than 20% down to purchase a home. Now, you can pay mortgage insurance monthly. You can take that monthly premium instead and maybe split it up and pay some of it monthly, pay some of it up front. You can take and do basically a single premium where you're basically paying out or buying out the mortgage insurance in its entirety. You could also elect a higher interest rate to buy out the mortgage insurance. So there's a variety of different ways to do that. You don't have the same flexibility with FHA, which we'll talk about in just a second. But I think the difference when you look at calculators on Redfin and Zillow, those PMI calculations aren't necessarily calibrated to the following. PMI is based upon credit score. It's also based upon down payment and then how much you finance. So the higher my credit score goes, the more I put down, the lesser my mortgage insurance is going to be. And with conventional mortgage insurance, there is a cancellation option. So once I have 2 years in my loan that I originate, and I have 20 to 22% equity, I can apply to my mortgage servicer to have my mortgage insurance canceled. Now, what you'll learn with the FHA, we don't have that cancellation option. But again, FHA is going to have a little bit more flexibility. Let's look at the conventional example down below here, which shows you an amount financed of $250,000. We have a client that has a 740 credit score. And then we factor in like a 3% down payment. So that MI or mortgage insurance is $135.42 a month. So not as maybe as expensive as you might think, because we're factoring in that credit score, the down payment, of course, how much that buyer is financing. Now let's turn over to FHA mortgage insurance, which is a little bit different. It is government insured. There's two forms of mortgage insurance. There's monthly mortgage insurance, which is always at 0.55% of the loan amount. That's regardless of your credit score, whether I'm a 620 credit score or 720 score. There's upfront mortgage insurance, which is at 1.75% of my loan amount, but that gets financed into your total cost of your loan. Now, FHA mortgage insurance doesn't have the cancellation option, so it's a little bit different than the conventional loan. So most of our clients that use FHA to launch into homeownership will be looking to refinance hopefully in the next year or two when rates normalize and maybe switch over to a conventional loan product. Now, if we look at that same financing scenario, we take the $250 loan amount, we have monthly mortgage insurance now that's at $114 a month, and then we have upfront mortgage insurance of $43.75 that gets added into our amount finance. Now, as you can see the numbers, FHA is a little bit more reduced on the monthly side, but we do have that upfront mortgage insurance that we're going to have to factor into our overall balance. Now, when you're doing that comparison, you may think to yourself, why would I choose like FHA over conventional or vice versa? The reality is not all clients will fit into a conventional loan, and it might be a better fit into an FHA loan, whether it's because of credit score or income qualifying or down payment resources. So as we meet with clients to design their own home buying plan, we're going to kind of figure out what's the best match. It could be even the VA home loan product or the USDA product. And so those are conversations we have with our clients just to design the right resources around you. Now, as we start designing options for clients, we do take a look at income from a qualifying perspective. And I think it's helpful, in our class just to understand what generally a lender is going to ask for. So usually it's the last 2 years of taxes and W-2s, usually recent pay stubs, 30 to 60 days. And then we do need to verify assets as well. So usually that comes in the form of bank statements for the last 60 days. Now, around income, I do get a lot of questions from buyers about different scenarios. In fact, if you have questions in tonight's class, you can drop those in our Q&A or a chat function. We can answer some of your scenarios you might even have. But there's a rule out in lending which basically requires clients to have at least 2 years work history and or educational history. And so that gets a little confusing for buyers. The way that rule works, and let's use an example. Let's say I graduated from KU in the spring and I'm getting ready to start my job in the fall. If I had 4 years at KU and I'm just getting ready to start my job, technically that 4 years education will count towards the 2-year requirement for me to purchase my home. So I don't necessarily need to have 2 years on my job. I just have to have 2 years employment and or educational history. We also see scenarios where clients have been on a job for, let's say, a year, and they're getting ready to switch to another job, but they want to qualify for their mortgage. We can use the new income that they're going to qualify for based upon an offer letter or whatever type of documentation they can provide to us. So they don't necessarily have to either have started on that job or been on that job a certain amount of time in order to use that income for eligibility. Now, where the 2-year requirement gets a little bit trickier is in 2 areas. One is if I'm self-employed, I do have to show that I've had my business active filing for 2 years of taxes with my federal income taxes. So that's where the 2-year requirement comes into play. Now, the other side of it is too, is if I have dual employment, let's say I'm working for 2 different healthcare agencies, right? Let's say I work for one for 40 hours a week, the other one's 30 hours a week. In that case, I have to show that I've been working for both simultaneously for the last 2 years. Okay. Now, another question we get from clients is working a 40-hour work week job, but let's say I drive for Uber on the side or Lyft. In that case, I do have to show that I've been doing both my 40-hour work week job and working self-employed simultaneously for the last 2 years. Okay. Now, one other question I'll leave you with before we kind of move on is that we do get questions around other sources of income that are in the household, but not necessarily part of the application. So if you have a partner that's not going to join you on the application, or maybe you're getting some like rental income for a room and board for a tenant or something, that income generally can't be used for qualifying purposes. So we would basically just be able to use the income that we can document from the borrower. Now, one of the things we look at in income is a calculation called debt to income ratio, and it takes into consideration your pre-tax income versus your monthly expenses. The expenses we're looking at is some things like your new housing payment, maybe personal loans, credit cards, auto payments, personal loans, anything like that that would generally appear on your credit report. Generally, we don't want those expenses to exceed more than 43 to 45% of that pre-tax income. The debt to income ratio calculation looks a little bit like this. So we take into consideration the principal and interest of your mortgage, the property taxes you're going to pay, homeowners insurance. Maybe I'm putting less than 20% down, so I want to bake in the PMI. If I'm buying a condo, maybe a townhouse, maybe a community that has, some planned development, then I have an HOA expense or homeowners association dues. So in this scenario, if I'm a buyer and I have $2,500 in housing expense, and my other debts are $500 a month, then I have $3,000 in outgoing expenses. If I was making $8,500 a month, then my debt to income ratio is 35.29%. Now, most of our clients that we consult with across the country feel pretty good at that number's around 33 to 36%. And so that's kind of the comfort zone, but guidelines in financing will allow you to go 43, 45, and in some cases as high as 50%. But, we want to be cautious with that because we want to design options for our clients that are both affordable but sustainable over time. In fact, I was meeting with a client today earlier in the Bay Area markets here in California, and they were at 34% debt to income ratio, but that felt a little bit tight for them in terms of what they were buying at. So as we're having conversations with our clients, we're going to figure out what the right design is for you. If it feels good at a $2,500 housing payment, maybe that's good. But if it starts pushing us to $3,000, then maybe we have to kind of slow down or maybe reduce down the eligible sales price to make sure, again, we can create an affordable scenario and a sustainable situation for you over time with homeownership. Now, the last thing we want to talk about when it comes to kind of designing like an all-encompassing home buying plan is the savings for homeownership, right? And you probably heard me mention earlier, there's two kind of challenges, either credit or savings for homeownership. Here's the documentation that we generally need to document assets, like I said earlier, checking and savings accounts. You can even use 401ks and 403bs towards homeownership. Family can contribute towards homeownership for you. There's a way that we document that through what we call gift funds. And so that's really simple, where we provide a gift letter to the donor as well as proof of those assets that they're contributing. Now, with savings, it can be a challenge for clients, especially if they're looking to buy immediately. There are resources like first-time buyer programs available all across the country. We're going to talk about those in just a bit. But I think from a savings perspective, I like to share with our classes a really simple kind of daily discipline, your monthly discipline, I should say, that you could institute for yourself to help kind of create more savings for yourself as you're preparing for homeownership. And that's really simple. And here's what that looks like. So let's say that I'm spending $2,000 a month in rent, right? But after meeting with Jason, I feel like I can get my monthly housing budget to $3,000 a month. So I'm renting at $2,000 a month. I think I can afford $3,000 a month from a homeownership perspective. So if we're not quite ready yet because we haven't created enough savings for ourselves for down payment and closing costs, what I would encourage you to do is start making payments to yourself like you're paying a $3,000 mortgage payment. So every month when you're paying that rental payment of $2,000, carve out that additional $1,000 like that would be for your mortgage payment and just make a transfer to your savings account, right? So that's $1,000 that goes into our savings account every month. By the end of 6 months, we're at $6,000. By the end of the year, maybe we're at $12,000. And that discipline does two things. One is helps us grow our savings and our resources over time, but it gets us into the habit of making that higher monthly mortgage payment, because trust me, it's a transition going from $2,000 to $3,000 a month in mortgage payment. If you can develop that now, I think it'll make the bridge towards homeownership that much easier for you. Now, I mentioned to you about first-time homebuyer programs. We're going to kind of spotlight a national program for first-time homebuyers. And so this is brought to you by Freddie Mac through the Borrow Smart program. It allows you to get a grant of up to $500 to $1,500 towards down payment or closing costs. Now, there are local programs available to you, whether you're in Kansas or you're in Texas or you're in Florida, wherever you're joining us from. There are usually state agencies called housing finance agencies that can help provide resources for you. So, if you do need a list of those resources, or certainly after, getting a chance to consult with us, we're going to give you some of those resources too. But those are kind of all across the country, and it just depends on what state you're in. Now, I know many of you are probably kind of seeing some of the proposed, first-time buyer incentives in the presidential election that are out there. There's some kind of talk about a $25,000 first-time buyer assistance program on a federal level. I'm sure we're going to probably get more questions about that as things kind of get further down the road with elections. But those are things that do take time to process. But certainly, if there's assistance available at a federal level, that'll be certainly useful for our buyers across the country. Let's talk a little bit about the buying process as we get towards the latter stages of tonight's class. I want to kind of walk you through the 6 steps of home buying. And these are different milestones that you would go through as a buyer. And after leaving tonight's class and you're maybe thinking about getting connected with us for a consultation, that would be kind of the next steps from tonight's class. That consultation is a comprehensive review of home ownership for you. Now, if you decide to get pre-approved out of that consultation, that'll lead us to step 1, which is the pre-approval. And what a pre-approval does is it's a document that you can present to a seller that shows your eligibility for financing. It says your sales price, your interest rate for your program, your loan amount, how much you're going to put down, all those things, so the seller can have a good idea of what your financing looks like. That pre-approval is usually good for 60 days, but it can always be recertified at any time. As I mentioned earlier in class, many of our clients are going to be kind of planning for several months out. So, whether you get pre-approved now and get recertified next year doesn't really make a difference, because you do have that soft credit check. But more importantly, I think it's really understand kind of the basic baseline for you of homeownership. So whenever the time is right for you, you kind of know what your numbers look like. So the next step would be house hunting. That's where you get a chance to go out and look in your communities, whether online or in person, at different homes that fit your budget. We'd encourage you to get connected with a realtor in your market. They can help kind of show you what different options might look like. Now, you may get pre-approved for $350,000, but maybe you stumble across a house that's $300,000. We can always adjust your pre-approval at any time. So just because you get pre-approved at $350 doesn't mean you have to buy a house at $350. Usually what we're trying to do is kind of create a baseline number for you based upon where you feel is an affordable monthly payment. Now, let's say, for example, our offer gets accepted and the seller says, yes, I'm going to accept that offer. Then we're going to start what we call the escrow process. And that's step 3 in the process. Now, usually the process from acceptance to when I get the keys to my house, it's about 30 days, depending on what state we're in. But once that offer gets accepted, it kind of starts moving things down the road. So when the seller has accepted your offer, now as a buyer, you're generally expected to make what we call an earnest money deposit, which usually needs to be transacted in the first 2 to 3 days of the contract period. That deposit, depending on what state you're in, is usually 1 to 2% of your purchase price. That will go as money towards your total out-of-pocket expense, like down payment and closing costs. Now, the day we get the contract from your realtor, we'll give you a call and say, congratulations, your offer's been accepted. We'll kind of talk a little bit about your contract. We'll talk a little bit about the state of the market, and then we'll schedule you for what we call a follow-up consultation. And that's where you and I meet for a one-on-one, just to reaffirm all the details of your financing, talk about the timelines of your contract, the monthly payment, what your out-of-pocket expense is going to look like, all those really important components of your home ownership. This is a slide that kind of shows you a little bit more about earnest money deposit and what that looks like. And usually in most contracts across the country, there will be what we call as a contingency period, which allows you as a buyer to do your homework on the property or your due diligence. Usually it's in 3 areas. It's 1, appraisal, where we want to get the house appraised to make sure the home is worth what you're buying it for. 2 is we want to get the house inspected to ensure that the home is up to the condition that you expect it to be. And then finally, 3, we want to make sure we get your loan approved to make sure all your financing checks out. And usually in most states, you're going to have a first 14 to 17 days, maybe as high as 21 days in your contract period to do all that homework. Now, if something maybe doesn't check out for you in one of those 3 areas, you do have the option, as long as you're in your contingency period, to cancel that contract because maybe just it's not the right fit for you. Now, step 4 is the administrative tasks of your loan. That's where we get a chance to verify your income, your assets, maybe some documentation for your first-time buyer program. And generally by that time, we're either locking in your rate or we're thinking about, strategy for your rate lock. Now, in today's market where we're seeing interest rates start to come down right now, those are really important conversations we're having with clients because, markets are moving by the minute. But the day that we decide to lock in your interest rate, that's the rate you get for your financing. So if rates are 6.5% today, but then they drop to 6.3, we may not be able to participate in that lower rate depending on your product. So there's some strategy that certainly comes along with locking in your interest rate. And then step 5 is your loan approval. Now, keep in mind, we're still within the contingency period, but at step 5, we've now issued your loan approval. That means an underwriter has verified your assets, your income, the program, everything is all aligned. At that point in time, we've also received your appraisal back. We've checked out the value. You've probably gotten your inspections back from your realtor and or your inspector. And at step 5, we're going to issue to you what we call as a final closing disclosure. And what that disclosure does, it gives you a 3-day cooling off period before we get to the very final milestone called closing your loan. And at the closing of the loan phase, you're going to be signing documents in person with a public notary. Now, all the disclosures you receive as a buyer leading up to that point are always electronically completed. But at step 6, you do have to meet either with a notary or with an attorney, depending on what state you're in. At that step, you're also going to be required to wire in your final amount that you owe for your transaction. Your documents, once signed, will get returned to us as a lender. We'll do some final audits on the documents to make sure everything is kind of all complete. And then we'll wire in the funds for your mortgage. And those monies get reconciled by an escrow or attorney team. And it basically is just all the contribution for both your out-of-pocket and your financing. That money gets all balanced out with the escrow team, and then they record documents with a county recorder's office, which they're going to record a grant deed, which transfers ownership to you, as well as a deed of trust for your loan. And then after all of that's confirmed, then guess what? That's the day of celebration. You get a chance to celebrate because now you're an official homeowner. So I've got a chance to make a few of those calls today. And it's the most rewarding part of my day because, it's a big accomplishment for our buyers to basically make one of the biggest financial investments that they've had up to this point in time. And so we want to be there to celebrate that with you. And it usually starts with classes just like this, believe it or not. So clients will get a chance to get educated in our classes. When the time is right for them financially, they'll get connected with us. And speaking of getting connected with us, here's how you get started in moving forward. So if you want to meet for your free consultation, there's a really simple process. You complete an online application, you upload proof of income and assets, and then you use our really simple scheduling system to schedule a video consultation at a time that's convenient for you. And we meet for about 30 minutes just to design that comprehensive home buying plan. And those are one-on-ones with me. I meet with clients all across the country, whether you're in Kansas, Texas, you're in Georgia, California, you'll be meeting with me over video to go through that design of your financing. And it's not something that's time sensitive from the perspective of we don't expect you to run out after your consultation and go buy a house. We want to just give you a roadmap towards home ownership. Here's what that consultation looks like. We're talking about budgeting. We're talking about savings plans. What does our credit look like? Are we eligible for assistance programs? So we want to give you all kind of the ingredients you'll need for a successful home buying plan. So this is kind of what that looks like. And we have some great resources to help you on this journey as well. A lot of them on mobile, like our mobile app, which can allow you to start the application process. You can get push notifications via email. You can upload documents. And a lot of our clients use the calculator function within mobile. So as they're out looking at a home, they're like, oh gosh, I wonder if that fits the budget that Jason and I talked about. They can do all those calculations right from mobile. Now, we're proud of our KU alumni partnership. Again, we're in the first year of partnership, but it's a really blossoming and fruitful relationship, and we're excited that you can join us in tonight's class. We also have other partnerships across the country, other classes that we teach. We'll teach over probably 60 classes this year in homeownership. So if you have friends, family, coworkers that would benefit from some of these resources and want to attend these classes, they can always check those out. Now, you have your own KU alumni site that's available to you. It's at kualumnimortgage.com. But folks that are outside of the KU alum, they can go to mortgageeducate.com, take a look at some of our upcoming classes. Here's all my contact information. So if you want to get reconnected with us after tonight's class, feel free to reach out to me, shoot me a text, call. email, whatever's good for you. And then, like I said earlier, if you want to schedule a session with us, you can use our scheduling system right here. And we're going to provide all this presentation material to you tomorrow, so we'd encourage you to check it out. And we'll have the recorded version up on our YouTube channel as well tomorrow. Speaking of social channels, I encourage you to follow us on our Instagram. We have a lot of great content we try to put out at least once or twice a week. You can follow us at Meda Mortgage for all those details. You can also follow us on our YouTube channel for any updates there as well. So with that said, I know we got a little bit of time before we get to the top hour. I didn't really get any questions through tonight's class, so I just want to see if the group has any questions. You can use the chat function or Q&A in Zoom, and I'll answer those questions on air for you. Okay, anything from the group? I know our audience is probably getting ready for KU football season, so I know we probably don't have a lot of questions, so we're probably more focused on upcoming college season. So, all right. Well, other than that, if you do have some questions, feel free to reach out to us. We'd love to be able to get you all the tools and resources you need. I do appreciate you taking time out of your busy schedule to join us on a Wednesday night. I look forward to hopefully connecting with you all in the future. Have a good night.